Today we have Mohnish Pabrai joining us, and he started the Pabrai investment funds, which were inspired by the original 1950s Buffett partnerships and are a close replica of the original Buffett partnership rules. And Mohnish is an ardent disciple of Warren Buffett and closely follows his principles on value investing and capital allocation. And from inception in 1999 through March 2021, you'll have to update our numbers, but a $100,000 investment would have grown to 1.4 million, which equals an annualized gain of 13%. Fantastic. Mohnish was the founder and CEO of Transtech, an IT consulting firm, before he started his value investing career, and he loves playing duplicate bridge. I don't know, Mohnish, if you want to take it from there.
Charlie, it's a pleasure and an honor to be with all of you. And just a quick story. I hope, Charles, do you go by Charlie or Charles?
Charlie, usually.
Charlie's a better way to go.
Yeah.
I've known Charlie's dad for more than 2 decades now. I think a wonderful guy, Larry Oberman. I met Larry many times in Omaha when he'd make the annual trek in the 90s and early 2000s. One time I went to his office in Northbrook, Illinois, and he gave me, very generously, gave me all the annual reports for Fairfax Financial. It was like, 20 years of reports. And of course, now I have a great friendship with Prem Vatsa at Fairfax. He's one of the largest donors for our foundation. And we did very well actually investing in Fairfax when it was being heavily shorted during the financial crisis. So I have a lot to thank Charlie's dad for. But I remember that when Charlie was born, his dad sent a picture of Charlie to Warren Buffett and said, Warren, have a new baby boy, and we've named him Charlie Warren Oberman in honor of Charlie Munger and Warren Buffett. And Warren Buffett wrote back, he said, when Charlie has his first stock tip, call me collect. Anyway, so Charlie, did your dad ever send any stock tips to Warren after that?
I don't think so. I mean, I give my dad stock tips, but I don't think that he passes them along.
Make sure he knows that he owes Warren your best idea.
I'll let him know.
So give him your best idea and tell him to send it to Warren, because Warren's been waiting for 2 decades.
I don't know if I can call him collect anymore.
He's got 150 billion because he's waiting for Charlie. So let's not make him wait anymore. What I thought might work well is if we could run the session maybe as a Q&A. It was really fun to get your email, after a couple of decades. How old are you now?
I'm 21. Most 21, of the people on the
exactly.
Call
so this
like
is after
18 to 22.
All right. So basically, this is after 21 years that I'm hearing from Charlie Warren again, which is great. But yeah, so please take it away. We're happy to engage. And other than just questions on what we currently own, I think anything is fair game.
Yeah. So we had some people submit questions who are on the call. So I guess to those people, we read through your questions and they're good to go. So if you want to send them in the chat, you're good to do that. But to start off, one question that we got a lot of just based on the bio that we sent out when we were trying to market the event is if you could go into a little bit more depth about your relationships with Warren Buffett and Charlie Munger and how those developed.
In 2007, I think our net worth at the time was around like 80 odd million. Almost all of it I would attribute to me using the intellectual property of Warren Buffett without paying any royalties. And I had such a huge influence on my life, just like your dad, and just not even just investing and on other facets of life unrelated to investing. So I felt like I owed him like a big tuition bill because I'd learned so much. And Buffett runs this annual charity auction on eBay where you can bid and the highest bidder gets to have lunch with him. My thinking was that I would bid for that lunch. At that time, the lunch was going for around $250,000 or so. And I said, I think this would be great. I can bid for the lunch. I had tried a couple of times before that and I'd always been outbid. But 2007, I was ready. I had net worth had gone up and I said, okay, this time we're going to go make sure we win. And I talked to my friend Guy Spear about it and he came in with me as well. And I think 650,100, we won that lunch bid. And my only expectation was to just thank him. I said, they just gave me a direct kind of one-on-one time. But Warren Buffett, when he runs this annual charity auction, he has a different kind of mental model. His model is that whatever people have paid for this lunch, he realizes it's a big deal for whoever's won it. he wants them to believe that they got a big bargain. And basically, so now the lunch goes for like 3-4 million, and he still focuses. So when I met him with my family and with Guy and his wife in 2008, Smith and Wollensky Steakhouse in New York City, Buffett basically, as soon as he sat down, he said, look, I have nothing going on all afternoon. I'm here with you as long as you want to hang out with me. And when you guys get sick and tired of me, you can let me know and I'll leave. But I don't have to leave. I can be here as long as you want. He just wants to make sure that he's providing more value and such. And I was addressing him as Mr. Buffett, Mr. Buffett this, Mr. Buffett that. And then, both my daughters were sitting on both sides of him. One was 10, one was 12. And he said to them, look, if you call me Warren, maybe the adults will learn, And so within about 5 minutes, you feel like you're having lunch with your grandfather. So it puts you at ease. You forget that you're with, this amazing historical figure and such. During the lunch, I told Warren that my wife, Harina, she's a huge fan of Charlie Munger, a lot bigger fan of Charlie Munger than Warren. I told him, look, Harina is happy to be here, but her true love in life is Charlie. Warren is very competitive. So he says, Charlie is an extremely old and boring guy. Okay. I'm the one who's really interesting and exciting, not Charlie. He's just, this curmudgeon. You don't want to spend time with him, always pessimistic and so on. And then, he told us, he said, look, just to make sure you guys understand who's the better lunch date, I'm going to have you guys meet Charlie for lunch. And then after that, you'll know who's a better company. And I thought he was joking, because Charlie doesn't do these lunch auctions. You can bribe Warren and have lunch. You cannot bribe Charlie and have lunch. Okay. There's no platform to do that. But the following week, I got an email from Warren's assistant going to Charlie's assistant, basically saying, I met this couple in California. They're really fun. And I think you'll enjoy meeting them. And they seem to have the misconception that you're more interesting than me. But once they meet you, they'll know that I'm the guy. It was buy one, get one free. We got the one lunch, and then the second lunch with Charlie was free. And I actually enjoyed the Charlie lunch more than the Warren lunch because he's just so candid, and so open. And Warren is also very candid and open, but there's a veneer of diplomacy, which is not there with Charlie, which is better. The lunch with Charlie led to a nice friendship with Charlie because we were in the same geography. And I started meeting him periodically. And then a few years later, I started playing bridge with him at the LA Country Club, usually Friday afternoons from like noon to 5 or 6 o'clock. We'd first meet for lunch for an hour or two. And then we'd play 3-4 hours of cards. Now Charlie doesn't go to the club anymore. I think he's going to be 98 in January. So those experiences, and Rick Goren used to join for those lunches as well, which is great. So the Warren lunch led to a very nice friendship with Charlie. But, like the Ginzu knife commercials, but wait, there's more. Warren has this party every year on Sunday. It's a brunch where he invites all the managers of Berkshire Hathaway and the board members and his close friends. Like Bill Gates is there. Sometimes Bono shows up. It's like, who's who. There's always some Hollywood celebrities there and whatnot. And he invites all the past lunch winners to that brunch. And so Guy and I started getting invited after 2008. And we used to always look at each other and say, we are the only two low life in this room, Everyone else is happening. And sometimes, we'd be at the brunch and I'd tell Guy, right behind us is Bill Gates talking to Bono. Okay, so we have these, and then, there'd be NFL players there, and then the founder of Spanx. You just meet all these amazing, that NFL player, the big guy, last name Sue, Nagadanum Sue, something. Anyway, such a gentle guy. And then I see him on the field. He's not at all gentle, but in person is so gentle, so nice. Those lunches have continued. And then, I got to know Warren's assistant through the lunch. And I asked her if she would meet Guy and me for lunch. And she said, oh yeah, she'd love to do that. So we started having lunch with Debbie on the Thursday before the Berkshire meeting. She said normally Friday is crazy in the office, but if you come on Thursday, I'm free on Thursday. So every Thursday, once a year in May, we'd go to lunch with Debbie. And I found the lunches with Debbie were better than the lunch with Warren or Charlie. Because I'd always tell Debbie, listen, between us girls, can we talk? Okay. She said, what do you want to know, Mohnish? Tell me, I'll tell you anything, So this was before we knew whether Warren had a cell phone, in 2010, 2011. I asked Debbie, I said, Debbie, does he have a cell phone? So she'd laugh. She said, well, he has a cell phone. It's a little flip phone, but it sits in my desk. And she said, he doesn't know how to use it. And when he goes on a trip, I charge it and give it to him. And the only thing he knows how to do with it is when it rings to open it and answer. And he knows how to call me because I put myself on speed dial. So if he has to call someone, he calls me and then I have that person call them. He says, and there's nothing else he knows how to do with that phone. Okay. So anyway, there were a lot of interesting things I found out about how Warren kind of operated and, how he spent his day and different things. And we'd go to Omaha to Berkshire headquarters. Some years Warren would be there. And then I think one time he gave us a tour of the headquarters. And then I've exchanged some letters with him. I sent him some stock tips. Since you're not sending stock tips, someone's got to send the stock tips. And so I'll send him stock tips once in a while. It's kind of a little bit surreal for me because, we are not as humans supposed to live in the time of Einstein or at the time of Newton or at the time of Gandhi or anything like that. But here we are actually living at the time of what I think will end up being two historical figures that will go down in history. And even 100 years from now, 50 years from now will be, talking about them and such. And so the fact that they are in the flesh with us and the fact that, by accident, I got to interact and got to know them, it's been a lot of fun.
That's great. So I guess switching gears more to like your process. So a question that we've had come up a lot throughout the semester, especially with it being a lot of undergraduate students in the club, is developing a circle of competence when we don't really know that much. And I've mentioned in the club like about John Arriaga, which I think is one of your favorite examples.
Sure.
But I was hoping that you could expand on that and just help us figure out where we can look to expand our circle of competence.
Yeah, like the Arriaga example, the size of the circle doesn't matter. You can have a really, really small circle of competence, but what is very important is staying within the circle, not even going to the edges, stay in the epicenter. And, to ask the question is to answer it. So if you're wondering if something is within your circle of competence or not, the answer is it's not in your circle of competence. And probably I think at your ages, what is likely the most probable to be within your circle of competence are products and services that you use regularly. Generally speaking, I think a good way to kind of begin your journey in terms of understanding, what businesses to look at, just look at all the products and services you consume. Do you go on YouTube? Do you go on Facebook? Do you use Google? Do you use an Apple iPhone? Do you use an Android phone? What brand of clothing do you wear? What kind of toothpaste do you use? Just, all your daily habits. What kind of drinks do you like to drink? Food you like to eat? And that's, I think, a starting point, because generally speaking, for a brand to come through and be something that you would trust and use is a very high bar. And usually they have to have some very special attributes and characteristics for the business to get there. And so I think that's probably the simplest way to start tackling the circle of competence issue. And also, I think it's not that hard to figure out what is a good business and what is not a good business. It's relatively easy to start, segregating those. So if you are familiar and a consumer of products, which then you can tell whether they're a good business or not, then once you know that there's a few products you use, a few services you use that are good businesses, then from then on, I think you can start trying to figure out whether an investment makes sense and diving deep and figuring it out and so on.
That's great. A lot of people are asking about a combination of your process when you're like reading articles or books, listening to podcasts, and then also where you're sourcing those from. And if you can go into that for a little bit.
Well, I mean, I think that the best way to, I think, approach this is kind of like as if you're a gentleman or lady of leisure. I'm curious about a lot of things. I'm very curious about a lot of different businesses and how they work. I'm always trying to, I'm reading autobiographies or biographies. I was just listening to a podcast. I'm in the middle of it right now, which is between Reid Hoffman and John Elkann on Reid Hoffman's broad podcast. And John Elkann is the chairman of Fiat Chrysler. We'd made that investment maybe 9 years ago. I'm still learning stuff about the company from that podcast, even though I used to own the stock and I've known John for so many years. I read a few newspapers every day, the physical papers. You could do it digitally. If you run across interesting books or interesting people to understand them, I think what you're looking for is something that hits you like a 2x4 like aha moment, where some company or some business you may be a customer of, but you've then studied it and then you come up with some major, I would say, insight into the business that most other market participants probably don't understand and or don't appreciate. And if that insight is meaningful and valid, that becomes a big edge. And you don't need that to happen even more than once a year. The reading is just something to enjoy and, broaden your horizons. But through all of that, once in a while, you get these aha moments.
Great. Then next question was, somebody was curious about when you go through periods of underperformance, how you handle that, especially with outside investors possibly losing confidence, or you might need to reassure some people in how that works.
Yeah, I mean, I think the business I'm in, all of the assets could leave every year. People can redeem. I mean, basically, in effect, the entire asset base can be pulled. So it's a temporary pool of capital. And people have a variety of reasons why they would, redeem assets. There's only one reason why people give you assets, but there's many reasons why they could want to take assets. Only a few of them relate to performance, etc. It could be, life circumstances or whatever else is going on with the individual or family. My take is that that's just part of the game, part of the way the nature of that business is. If I were left with no outside capital and just had to, work with my own capital, I would still think it's a blessed life. I wouldn't really have many regrets about it. I accidentally went into the investment business. I just kind of stumbled into it. There was no plan to do that. The plan was to just, invest my own money. So I think that it's not something worth worrying about. I think you do the best you can, and people will leave for a variety of reasons. They'll join for a variety of reasons. There's a constant kind of assets coming in, assets going out. That's all happening. But it's not something I really spend time dwelling a lot into.
Hi, Mohnish. Thank you for joining us today. I'm reading through some of the responses as well. And one of the things that our members really wanted to hear ideally was a lot about leverage and how it affects, whether your valuation or how you kind of determine if that's the right thing for you. And how can you tell if a business is using leverage optimally, or how can you tell if the debt situation is kind of out of control, or if they have it in control? What are some of the things that you look at specifically with leverage?
Yeah, so I think with leverage, first of all, on a personal level, yourself as an investor, it's best to minimize or eliminate it. I mean, I think it's perfectly fine if you have a mortgage. It's perfectly fine if your cars have loans on them. In fact, I think it's a good idea for all your depreciating assets to be financed and your home to be financed. I think those are reasonable things to do. But I don't think you should have margin debt in a brokerage account, etc. I think that's not a good idea. And also not to play around much with options and derivatives on a personal level. So I think that's also not a good idea. But when you get past all that and you're looking at different businesses, I think it's pretty apparent whether a business is levered or not. I think that's pretty easy to tell on the balance sheet. Sometimes there are some liabilities which are off balance sheet, like leases, etc. But if you read the annual reports and such, I think it would become pretty obvious what their obligations are. The ideal great business is one that generates, very high returns on equity without any use of borrowed money or leverage. Like, we have a company in the US called Fair Isaacs. It's based in Berkeley. They're the ones who, have all the FICO scores. And so each time some financial institution gives you your FICO score, they get 1 penny or something. So it's a great business. And basically that business is very profitable. They don't really need any leverage, and they are a large portion of the revenue goes to the bottom line. But in investing, there are always, every situation has an exception. And they can be really good investments one can make in businesses which are levered. Sometimes the leverage can be non-recourse, or sometimes the terms can be such that the market is misreading it. It's causing distress on the equity for not very good reasons, and so on. So I think sometimes the presence of leverage can create great investment opportunities. But to keep it simple, if you just said to yourself, I would not invest in businesses which were levered, you could live a very blissful and profitable life.
Awesome. Kind of related to that too. I know a lot of people are expecting rates to rise in the next few months or even years. Is that going to have any effect on how we look at leverage or the amount of leverage some companies take on now that these rates are rising? Or how's that going to affect stock prices, do you think, going forward?
Yeah, I mean, if a business is levered and they are having difficulties, or the interest is a very significant part of their earnings at low interest rates, and that's a very serious concern, because you could easily get to a situation when they're upside down or they're tripping covenants and so on. So yeah, I think it's very important to look at the gearing ratios and how likely the business is to be able to withstand meaningful changes in interest rates. And in general, capitalism is brutal. Most businesses do not survive for more than a few decades, even the very successful ones. The ones that have leverage are going to be significantly less likely to be able to survive for multiple decades of time, because you're just adding a layer where you could have a very significant business downturn at the same time when rates go up, and you're kind of upside down, and then your lenders start to turn the screws on you. Those are not good situations to find yourself in.
I sort of have a follow-up to that. I was curious how much you think about macro events when you're investing, or if it's really focused company specific, and that's something that's sort of like really at the end where that comes up in your process.
I think investing is difficult enough if you're just trying to understand a business and how it works. I think when you start overlaying and trying to make assumptions, okay, here's what I think will happen to interest rates or unemployment or recession in this year or that year, all of those things most people are wrong about. Everything I thought that would happen with COVID in March 2020 turned out to be wrong. I mean, I would have never guessed that now we'd be sitting at all-time highs on the stock market after, more than 500,000 people died in the US. And we had all these lockdowns and stores and everything shut down, and businesses, people working remote. I also wouldn't have thought that remote work would have led to a more productive workforce, not a less productive workforce. These are all counterintuitive. And so I think that the best thing to do is not to give too much weight and not to think too much about the macro, because it's a lot harder and it may not have an effect in the end at all.
And then I have another question. So I interned at Capital Group this past summer. It was online, but I remember hearing about the Best Ideas Fund. I remember you talking about that. I couldn't find anything about it, but I'm curious what your checklist is to sort of keep yourself honest, make sure that you're not pounding something into your head that might be incorrect just because you've been looking at it for a while.
I think this is a Buffett quote. He says that a horse that can count from 1 to 10 is a smart horse, not a smart mathematician. If you are looking at a business that is the best in its industry, that may simply be the smartest horse. But what you want is the smartest mathematician. Fair Isaac might be better than the best steel company, for example, or the best oil and gas refining company, for example. And so I think that the interesting thing about capitalism is that there are some businesses which are so easy to run, which have such strong competitive positions, which have pricing power. And there are others which are so hard to run, no pricing power, lots of competition, on and on. And as investors, we have the choice where to go. Be patient and try to look for the businesses who have a natural advantage, not just the one that's the best in the industry.
Mohnish, I have another question kind of going like you're talking about picking the best in the, not just the best in industry, but picking, the best mathematician. A lot of our members kind of want to hear more about the moat aspect from the value investing principles. How can you kind of tell what a good moat is, or if a company even has a moat?
I think for the most part, it can be quite obvious if you just spend some time thinking about it. Let's say, for example, you use Instagram or Facebook, for example. You can form some opinion about the stickiness and how long those businesses could thrive and what would it take to unseat them. These are classic network effect businesses. They can be unseated if they're going to lose their way and such, or some disruptor comes in with a better mousetrap. But it's not so easy to do that. They would need to be completely sleeping at the wheel for a long time to allow something like that to happen. So I think it's something that you can start to put your arms around when you look at different businesses. If you look at a business like, let's say, 7-Up, for example, how does Sprite affect it? How do the other soft drinks affect it? How do other non-carbonated drinks affect it? What kind of pricing power does it have? And how do consumers think about it versus the substitutes and so on? And those will start answering your question about the nature of the moat and how wide and deep it is. And I think that if you cannot get to a point where something is a no-brainer, where you have been able to convince yourself that this is amazing, it just pass, because we even if you make one decision a year or two decisions a year or one decision every 2 years, that's perfectly fine.
Kind of a follow-up to that, is the moat the only competitive advantage that you're looking for, or are there other competitive advantages that you kind of see from an annual report or somewhere else that you kind of factor into your decision to invest as well?
Well, the moat is kind of all-encompassing. That's why Warren and Charlie use the term, because it's kind of, if you look at, Porter's 5 forces, for example, it's a lot more complex kind of description of what is a moat. But a moat encapsulates things like a low-cost producer. Sometimes the moat can be that you are just cheaper than anyone else in producing. Sometimes the moat is all about that you don't need to have as much markup as someone else, like kind of a Costco. They're always going to be under everyone else's price, and that gives them a strong moat. The moat, I think, is a very broad kind of shorthand for what gives a business an enduring competitive advantage. And the enduring advantage can come from a number of different places. Sometimes the enduring advantage is hidden. You can see it in the numbers, like the profits are great or the growth is great, but why it's great may be hidden. And then you kind of have a treasure hunt to try to figure it out.
We had a question in the chat that I'm actually going to make slightly more specific than it's written, but it's asking, how do you evaluate the quality of management when you're looking at a business? And I guess I'll add on to that, like as students, when we can't interact with management, because I know that you could probably meet with the managers of the companies that you're looking into.
Yeah, I think it's actually an advantage if you can't meet the management, because you're unlikely to be sold, which is a good thing. The simple way to evaluate management is simply look at the track record. What have they done over the last 10 or 20 years versus what they said 10 or 20 years ago? And that's pretty easily available. And so Warren and Charlie don't care so much about the projections of businesses making or the projections of managers making. What they care a lot about is what is the track record of that manager or management team. It's fun to go back into a business, go back 10 years, 15 years, look at the nature of the business, look at what the manager was saying, and then look at what transpired. Did they underpromise and overdeliver? Did they overpromise and underdeliver? Are they competent or incompetent? I think these things start becoming very apparent in most cases when you start looking at those things from a long perspective.
Yeah. And then we had another question that was submitted. So a lot of the people on the call are obviously interested in finance and investment management. And so some people were curious about what it is about the investment profession that you find most rewarding or most challenging or most tedious.
Yeah, I don't find it tedious. I find it permanently and thrilling and amazing. Investing is one of the broadest disciplines. It's cuts across many different disciplines, and especially depending on the business you're looking at. I mean, I gave a talk a few years back, it's on YouTube, about Coca-Cola and at UCI, UC Irvine. Coca-Cola is in many ways a pretty simple business. Almost all of us are consumers of, if not Coca-Cola, one of the products. They've got 100 brands or something, and we can very quickly kind of get an understanding of the nature of the business. But the kinds of things that affect Coke, from a psychology perspective, how it, the association tendency, when we see, celebrity giving Coke an endorsement or being used in an ad, the impact it has on us, or, just when we see the brand in different places and how it works. So Coke can get really complicated as you start to overlay how it works in different settings and geographies and such. So investing even in a simple business like Coke requires you to be open to multidisciplinary thinking. And that is the case with a lot of businesses you look at. The factors that affect a business are so wide ranging that you want to make sure you've honed in on the stuff that is likely to happen and understand what the likely impacts of that are. And that, generally speaking, will cut across many disciplines.
So we have a couple kids in the club that are involved on campus in like the entrepreneurship scene. And so they were curious how you think being a founder of TransTech has helped you identify compounders and just helped you in your value investing career, like how that all ties together.
Well, there's a Buffett quote. He says, what is it to walk on land? If you try to explain to a fish what it is like to walk on land, one day walking on land is worth more than 1,000 years of trying to explain to a fish what it's like to walk on land. So it's the same way with running a business versus reading about a business. I think that when you run a business, met payroll, made sales and lost customers, and had good customer service and bad customer service and employee turnover and challenges in hiring and all these other myriad things that you run into, those teach you a lot about the way the world works. And that experience that you get running a business gives you a better understanding of the challenges any business faces if whoever's running it is facing. So it is dangerous to look at a business through some spreadsheets. That's not a good way to look at a business. I think a better way to look at a business is to kick the tires, to really put yourself in the driver's seat of the CEO. Think about what 3 or 4 variables would affect most of the outcome, and think about whether you can handicap how those 3 or 4 variables would play out.
So I was supposed to actually have a presentation today about incentives for a finance class, but it got pushed back. But I was hoping that you could explain, some of the people on the call might not be familiar with how the Buffett partnership was structured. So I guess why you picked that structure from an incentive standpoint. And then I'm curious if you could start the Pabrai funds over again from scratch, if there's anything about that structure that you would change.
Yeah, I mean, I think I would not change that structure if I were starting again. And I think when I first encountered the Buffett partnership fee structure, basically Buffett had a number of different arrangements with different investors. But then in the early 1960s, he made it all uniform, brought them all into a single partnership. And basically he said, look, the first 6% every year that I make is going to go to the investors. And above that, I'll take 1/4 and the investors get 3/4. And if I have a down year, I first have to make it up. If I'm minus 10% in a year, I have to come up to base plus 6% annualized from that base. And after that, earn a fee. So everything about that appealed to me. I think it made a lot of sense. It seemed to be a win-win for everyone. It definitely aligned the interest of the investor with the investment manager. And I think it gives a lot of incentive to the investment manager. It's quite a lucrative scheme if you are a really good investor. I mean, if you're going to bang out 20% a year, you're going to get 3.5% on other people's money every year. That is quite a handle, the croupier's take is quite large. It can work well. And at the same time, your investors don't mind you getting that because they're also getting 16.5% after fees, which is also really good.
I have another question, and it's kind of more on the informational side of things before you're getting ready to actually make that investment. I know that you can probably never have all the information before you go into a decision, but how do you find that stopping point where you say, I think I have enough information that I feel comfortable making this trade?
Yeah, that's a great question, actually. I think with any investment you're looking at, I'll take a tangent and come back to your question. Many years back, I was talking to Charlie and he encouraged me to discuss my investments, not so much with an analyst who might work for me, but with a peer investor who cared about me and was a good investor. So he said, I always had someone to talk to. He said, Mohnish, and it's a big advantage because sometimes we as investors have blind spots. So I told him also, like in your case, Charlie, for example, you have Warren to bounce investment ideas off. He says, well, it wasn't always Warren, but it's very helpful to have somebody who you can discuss your ideas with. So we all have our circle of competence. We all have our blind spots. So one thing that is useful is to generally bring your ideas to some person who you trust and who cares deeply about you and is also a good investor. That's an important thing. But I think beyond that, you obviously want to get to an aha moment, which is telling you, here's all the reasons why this investment is a no-brainer. And the world doesn't get it, but eventually they will. And here's why it makes sense. I think that what I have found in 25 plus years of investing is the greed portion of our brain can sometimes mislead us. And so it's really important to have circuit breakers on that greed. So one of the circuit breakers I have is I have a pre-investment checklist. It has like 160 or 170 questions on it. And I run any investment through those questions before I invest. And the big value the checklist adds is that the first time I run it, it'll pop up maybe 10 or 20 questions where I don't know the answer. And what that says to me is, listen, dummy, you are not done with the work. You can't even answer these questions. So first go and figure out the answer. And figuring out that answer might take several weeks of work, which is fine, or might take several days. And once you can answer all the questions intelligently, the checklist has done its job. It's going to highlight things that are likely possible failure points in the investment. Every single company, you can come up with scenarios where that business is going to have struggles in the future. And the question you're trying to answer is, what are the likelihood probabilities that happens or doesn't happen in that business versus what you think are the good things that could happen in the business. So I think the circuit breaker is important. Talking to somebody you trust is important. Being patient and thinking through why something would not work or what are the issues that could cause a permanent loss of capital. That's where the focus needs to be. The upside will take care of itself. I think your aha moment is already probably showing an upside. The question is, how do you protect the downside?
Could you go through an example, not a current holding, but maybe a former holding that either worked really well and you learned a lesson from, or worked not so well and you learned a lesson from, just to sort of put some of this into practice?
Yeah, I mean, I think that we don't really learn much for the businesses that we do well with. Those just feel great. Well done, Mohnish. That's about it. That's all you're going to get out of those investments. It's the failures. I mean, it's the same thing when you're in school. The classes that are easy A's don't teach you much. The classes where you have to struggle and you maybe get a B or you're, C level, C average, trying to pull a B out or whatever. Those are the ones that really teach you a lot in investing. And that's why it's always important to have a real portfolio, real brokerage account, not do this through a spreadsheet, because you need to feel the pain. You need to feel the pain because you will lose money. It's guaranteed. John Templeton said one out of three times we're going to be wrong when we invest, at least one out of three times. I think that failures teach you a lot. In 2008, for example, I had an investment in a subprime mortgage lender, Delta Financial, went to zero. That was painful because we had a concentrated portfolio. We had 60, 70 million invested in it, and it all went to zero. I've had a number of difficulties over the years with investments in finance and banking companies. And I've come to the conclusion that I don't need to go there. So generally speaking, if a bank comes up on the radar, I don't even bother to look anymore. I just say it's a pass. Okay. Now, if you look at someone like Warren Buffett, in his entire career, he's, I believe, never been wrong on a banking investment. And he used to have an investment in a bank in Illinois, First Rockford, in the 1960s. It was one of the first acquisitions Berkshire had done. And I have a friend who used to be an intern at First Rockford at that time. And he'd say that Warren would show up once a month to visit First Rockford from Omaha. He traveled there. And he said the whole place would be in a frenzy for several days before Warren showed up because they knew, he never forgets a number. He's asking a bunch of questions. But that particular bank was probably one of the best run banks in the country. Their write-offs of bad debts for decades approached zero. So it was a single branch bank in Rockford. The founder knew all the major business owners, and the founder was very deeply involved in all the underwriting decisions. So pretty much every loan, and he had to approve it. And he wasn't going to approve loans to deadbeats. And they had an exceptional track record in terms of with the loans. And Buffett is a really good banking analyst. He's had investments in Wells Fargo, JP Morgan, Bank of America, M&T Bank, on and on. Every one of them has been a home run. And it's worked out really well for him. On the other hand, if you look at his track record with retailers, it's been terrible. And he doesn't talk about it much because he doesn't like to, discourage his managers. But I would say that almost all of the retail investments Berkshire Hathaway has made, which have been dozens of retail investments, only a couple of them have done really well. Nebraska Furniture Mart has done well. Borsheim's have done well. Almost every other jeweler they bought has done terribly. Almost every other furniture operation they bought has done terribly. And almost every other retail operation they bought has done terribly. Because in general, retail is just so hard. It's so hard to do well that even a Warren Buffett struggles. So there are SIC codes where Warren excels, and there are SIC codes where Warren does poorly. And that's the situation with all of us. And the earlier you figure out what you're really good at and what to avoid, like I've figured out, I took a lot of painful arrows in the back. I wish I knew this 25 years ago. And, but, I don't really want to own banks or finance companies. I repeatedly get hosed with those. And so I'm done, I had enough for a lifetime. On the other hand, I've done very well in other areas where, like in a lot of commodity businesses, which are low cost, those have worked really well, low cost producers. And a number of different kinds of businesses, which I've been able to handicap well, have worked out well.
How do you determine what price you will pay for a business? How do you calculate the intrinsic value of a business?
When you go back to circular competence, if a business is within your circular competence, by definition, you know what that business is worth. And you don't need to do this precisely, okay? Let's say I take a business like Coca-Cola. What is Coca-Cola worth, okay? I would say that it's likely that Coca-Cola's value, intrinsic value, is probably more than 15 times trailing earnings. It might even be more than 20 times trailing earnings. Maybe it's even 25 or 30 times trailing earnings, such a high quality business. But let's stick to 15 times trailing earnings because that's a no-brainer. We know it's worth more than 15 times trailing earnings. If Coke is offered to you at 5 times trailing earnings, it's a no-brainer. It's an aha moment. If it's offered to you at 12 times trading earnings, we don't know. And once we get to we don't know, we can take a pass. This is a game with no called strikes. And so we can let 1,000 balls go by, not just 3. And so Coke comes to you at 12 or 13 times earnings. Yeah, not really. Let it go. Then Facebook shows up at 12 times earnings. You say, hey, let's swing at that one. Okay. And you just keep doing that all day. You basically keep saying no to almost everything. And what happens is that once in a while, there are these aha moments. And I think the key is that it has to hit you between the head with like a 2x4, where you just cannot ignore it. Like I've mentioned in some of my previous talks, I was visiting Turkey and I ran into this company that is the number one warehouse operator in Turkey. It was really simple to figure out what those, their warehouses are 99% leased. They're leased to like Amazon, Carrefour, IKEA, very, very high quality tenants, long-term leases, 10 years, whatever. And it's really easy to figure out what the cost of a warehouse is, $30, $40 a square foot for the land and, $35, $40 a square foot for construction costs, like, $70, $80 a square foot. And they had 12 million square feet. So, it's maybe worth $1 billion, something like that. 900 million, $1 billion, something like that. Maybe 800 million to $1 billion, somewhere in that range. And there was a couple of $100 million of debt. Okay, so the thing is worth about like, let's say 600 to 800 million. The market cap was 20 million. If you see a cow, or a bull, which is huge, you don't need to know the weight to know that it's big and fat. Okay. I didn't need to know whether the liquidation value of Resas was 800 million, $1 billion, 600 million, 500 million. All of those answers were fine. Even 200 million was fine. I'm paying 20 million. Okay. So the only question left was, am I dealing with a bunch of crooks or are they honest? Like what's going on here, right? And I poked a lot at that. And I met the father and son, and I asked people I trusted, and they said, there's nothing we've ever heard which is untoward about them. And they came across as, pretty straightforward, smart people and hardworking people. And they had built this from scratch. I mean, they worked hard at it. So it was a no-brainer. So I think what you're looking for is these absolute no-brainers, and they do show up from time to time. And when they show up, then you step up to the plate.
I'm curious your idea of being a shameless cloner, if you've had to make any updates to that over the years, or if you think that that's like a timeless thing and it's going to stay perfect the way that it is.
Well, I think it's a big advantage to be able to leverage what other people have already figured out. I think that if you look at something like Dataroma, which lists, the top holdings of a number of prominent investors, for something to make it into the portfolio of Chuck Akre or Bill Ackman or any of those people, it's gone through a bunch of filters. Bill runs a concentrated portfolio. He might have 1 or 2 new positions. He's got a team. They look at hundreds of things, right? So if something has made it through, it's worth checking out and trying to reverse engineer why it made it. And so I think it's a big advantage to use as your universe to dig into what other people have already figured out. So instead of starting with, here's 50,000 stocks globally, let me go figure this out, that's a really tough job. But if you take that skill set, that data set down to here's 50 stocks, which are the top holdings of 10 or 15 investors that I really admire, or here's 20 stocks that are in that group, it's really relatively easy to go through the list and say, okay, which ones can I understand? That'll throw out a bunch of them. And which ones are great businesses? And that'll again throw out a bunch of not so great businesses. And then the ones that are great that you can understand, you can look at the valuations and go from there. Pretty simple.
That's all the questions I had. I don't know if anybody else has anything that they want to ask before we wrap up. Warren Buffett has said that he wants to buy businesses that are going to return on capital employed for a very long time. How do you know if a business is able to employ capital at high rates of return over long periods of time?
It's a great question. And, Munger would say, why should it be easy to get rich? So that the ability to answer that question has the possibilities to make you insanely wealthy if you know how to answer that properly. And it's not easy to answer that properly. So let's take a business like Geico. Geico is a direct writer of auto insurance, unlike State Farm. If I buy a policy through State Farm pays 10% or so of that premium to the agent who, independently owned agent, which is bring that policy in. Geico uses a call center. And so it has approximately maybe, 8, 10, 12% advantage over State Farm and Allstate. And that's a secular advantage. And that advantage has allowed Geico to go from nothing to, it used to be 2-3% of the auto market. Now it's 8, 10, 12%, and they're continuing to grow. But Progressive, which is also a direct writer of policies, has run circles around Geico. So Progressive invested very early in telemetry technology, which gave them a lot more data about how the cars were being driven by these drivers. And that allowed them to have a much better understanding of the risk. So they were willing to, they knew that certain drivers, you could offer even lower premiums than Geico, bring them in, and they'd still be profitable. Whereas Geico would look at the driver and say, I really can't take this guy below certain premium, because they were missing some data points. So that's an example of how, and Berkshire's now trying to fix that. They're behind the 8 ball trying to help Geico catch up to Progressive. My 2 cents is that Progressive is really good at technology, and they've had a long head start, and they're continuing to jam on this. So I think Geico's going to have a hard time. They might get there, 5 years, 10 years, they might get there. They still have the advantage against the other player, but they're not the best. They were the best 10 years ago. They're not the best today. And so one would not have been able to predict 10 or 15 years ago that we'd have this kind of issue come up with Geico, right? We just look at Geico and say, Berkshire Hathaway, they've got this advantage. They just keep chewing through and getting more market share. They've got great customer service. Who doesn't like the gecko? On and on. And you guys might not remember this, but there were these series of ads Geico had for the caveman. Do you remember the caveman ads? So the caveman ads were hot and heavy when we met Warren for lunch. So my daughter asked Warren, have you met the caveman? Okay. And Warren said, I'm sorry, I haven't met the caveman. Can you tell the caveman we really like him? It's so funny. Anyway, so, I think that this, or if you look at Coke and the sugar issue, and where does that go 10, 20, 30 years from now? Is it an issue? Is it a non-issue? Is most of their portfolio non-sugar, carbonated versus non-carbonated, whatever. So I think that if you look at Visa and MasterCard, incredible businesses. What do those businesses look like 10 or 20, 30 years from now? There's so much happening in payments. American Express, so much happening in payments. It may not be easy to figure those things out. So this question, we can clearly tell which businesses generate high returns on employed capital. That's black and white. It's in the balance sheet. We can tell income statement. It's easy. The nature of how long that can continue becomes a much harder question. And that's why we want a margin of safety. And that's why we want these aha moments. But if we can figure that out, in some cases, I'll give you an example, which is going on right now in my portfolio. I'll talk a little bit about one of the portfolio holdings. There's a company in India that I invested in about 3 years ago called Indian Energy Exchange. It is a network effects business that basically has 95, 98% market share, where electricity on the spot market is bought and sold through their servers. And whatever is bought and sold through their servers, they keep 1% of the transacted amount. When I first invested in the business, there's a company called American Tower. And American Tower basically owns, tens of thousands of these cell phone towers. And it's a great business because by the time you get the second tenant on that tower, anything incremental coming in is almost 100% margin. And then when you go from 3G to 4G to 5G, each one of those is adding more complexity and such. And once AT&T architects its network and has towers in certain positions, if you take out one tower, it affects how, what I'm saying is that you can't take out one tower and put another one a mile away. It affects the whole network. So in effect, the owner of that tower has a advantage where AT&T is probably going to keep paying rent well beyond the lease term because their network topography would change so much if they had to redo these things every time. So for a number of reasons, American Tower is an incredibly great business, and it's been a great business for a very long time. One of my friends used to be a fund manager at a large fund house, and they had an investment in American Tower, and they went. They had an investor day, so they invited all these fund managers to their headquarters, and they were going to have some meetings and presentations, and then play golf in the afternoon. So my friend showed up a little bit early, and he went to the CFO's office. He knew the CFO, and he saw the CFO just sitting there with his feet on his desk. So he asked him, "Hey, you don't look like you got anything to do." He said, "Yeah, I don't have much to do." He says, "Don't you need to do deals? You guys keep buying new towers. Don't you need to do new tower deals? Like, instead of just sitting with your feet on it." He said, "Look, everyone has my number. Anyone who has a tower for sale, they know how to reach me. And they also know exactly what I'm going to pay." He says, "There's no voodoo or work involved. The call comes in. We tell them, yes, here's the terms. Here's where you sign. We wire the money. We move on. My feet are still on my desk." Okay. I don't need to go have a root canal about this. That's the definition of a great business. Okay. And when you look at something like American Tower, it's likely that's going to endure for a long period of time. Now, there could be a disruptor. Elon could put everything on satellites, for example. Okay. And at that point, he's not going to have his feet on this desk. His feet are going to be shaking, okay, under the desk. But who knows how far that is and what the odds are and whatever else. And so I think that when I look at a business like IEX that we invested in, it was about 3% of India's electricity was flowing through their servers when we invested 3 years ago. Now it is north of 7%. It's become 7.5%. It's grown a lot. And India's per capita usage of electricity is going up as well. And the government announced some policy changes where it's probably going to get to 20 to 25% of the total electricity. It might even go higher, might be 30, 35%. It's huge to take a country the size of India where the per capita electricity usage is so small, and then you collect. And the way that business works, 75% of revenue is net income. Okay. When I visited their offices, I visited the offices in New Delhi a few times. It reminded me of Chuck Akery and my friend with American Tower. I saw this country club, relaxed place. Nobody's really stressed. They got about 40 software guys who don't seem to have much to do. And they got 30, 40 other people who also don't seem to have much to do. Everything's running through 2 or 3 servers they have. And the money is flowing, everyone pays them in advance. They have no bad debts, nothing. And whatever comes in, they have no expenses. Okay. It's a bunch of, bits running around on a server, and they collect 1%. They've got no expenses. They just pay for the software people. So as their revenue grows, this 80-person company might become, if it becomes 10 times the size in revenue, it might go to 120 people. 50% increase in people for 10x the revenue, and the 72% might become 82%. Okay. So now the question is, how long can this continue? Okay. I don't know. We've had so far 5x or 6x return since we invested. Well done, Mohnish. Like I said, we don't learn nothing. IEX teaches us nothing. Okay. It just feels good. Okay. But I don't know how long it can go on. It could go on for 20 years. Okay. If it goes on for 20 years, hallelujah. God loves me. It could go on. It might be like in 3 years, some policy changes come in and something happens or whatever, upsets the apple cart. We don't know. It's some of these things are kind of hard to figure out, but my best guess is let it ride. So we have a India fund where IEX is now like 40% of the pie. And we're like saying, it's okay. We just keep our investors informed. And I said at 95%, when it gets to 95%, which it might, the way it's going, as long as we can just let everyone know, listen, guys, 95% of your money is in one stock, and disclose that properly. If you don't like this, you can exit or whatever else. I think we're okay. But you don't get many opportunities like that. And I made a mistake with IEX. I used to own 5% of the business, which was the most we could buy. And then COVID hit and I was concerned. It always looked expensive. That's the thing. When you look at Fair Isaac, like if I look at IEX today, trailing earnings, it might be trading at 80 or 100 times earnings. Okay. Because it's a spectacular business that's growing like crazy, so it's never going to be at 8 times earnings. So anyway, I think that question is a great question, and it's a great question to think about. And you only need to figure it out once. You only need to find one IEX or one American Tower. And if you're right about that runway for 30 or 40 years, just sit there and let it rip. And you're done. That's it.
Thank you so much for your time today. This was great.
You look a lot like your dad. Tell him I said hi.
Is that a compliment or an insult?
That's a compliment. He's a good-looking guy.
Yeah, I'll let him know.
All right.
Thank you so much.
Like I said, I enjoyed interaction with both your parents, both wonderful people, and it was great to say hi. And do you guys play Clemson often?
I think that we have a home and home scheduled with them. I was looking at it with my roommates. I think we have a home and home scheduled with them in the next couple of years. But yeah, we played them at the beginning of this year. I went to that game. That was pretty fun.
Clemson lose that one?
Yeah, Clemson lost.
Yeah, I remember that one. That was not expected.
Yeah, a lot of people are saying that Clemson's not as good this year, but my roommates and I were saying that Georgia broke Clemson, that it was like we did it to them. So that's how we're trying to justify it.
All right, that sounds good. Well, you probably know that, the orange in my room is because, I'm bleed orange when I cut my wrist or whatever. So, but anyway, go Bulldogs and go Tigers.
Go Dogs.
Yeah.
Thank you so
much. All right.
much.
Thank you.
Bye.
Okay. Bye.